Given your view of the deficit and certainly the longer end of the yield curve, is that why is it a fact that you still like intermediate dated bonds, nothing longer than the 10-year like you told me before?
Yeah, we still believe that the yield curve continues to steepen. Irregularly, of course, but we were negative 108. The 2-year Treasury was 108 basis points above the 10-year back in last summer. And now it's at 34 basis points positive. We've had a huge swing on that, and I think it has a lot to do with supply problems. And I don't believe that the deficit is going to improve under the Trump administration. You can find, $50 million here and $6 million there through something called, the Doge thing, or the dog E, as I call it. But I don't think you're with looking at some tax cuts and forever spending on wars and natural disasters and all this stuff. I don't think the deficit's going to go down under Trump. And that's going to be a problem with the Fed on hold. And now the bonds that were rolling off from 5 years ago with coupons of 0.5% or 1%, it looks like they're going to be solidly in the 4.25% to maybe 5.25% range when those bonds roll over, and there's a lot of them coming up. So the long end, I would continue to avoid it. I like the intermediate part of the market. It's not nearly as attractive as it was 18 months ago. Spreads are much tighter on credit products. The Treasury rates are lower than 18 months ago. But when you take a look at the inflation rate, even if it's at 2.5% to 3%, you have a real rate of return from fixed income. I think you should always have a real rate of return from fixed income. We've lived through so many years of repression of interest rates that we had zero or negative interest rates versus the inflation rate for a long time. We should always have a term premium in bonds, and we have one now. So bonds aren't all that risky, but I do think that under the fiscal situation that we'll likely see another move up in the 10-year Treasury yield.
Everybody, obviously, you, me, every investor, the Fed chair himself, as he made it clear today, trying to figure out what the impact on the economy and inflation tariffs are going to have. The proposed Commerce Secretary, Jeffrey, Howard Lutnick, said today on Capitol Hill that it's, quote, nonsense that tariffs are inflationary. What do you think?
Well, he's got an example to point to. It's a sample set of one, but the last time the tariffs came through, we did not have an inflation problem. Back under the first Trump administration, there were tariffs, and inflation did not stir whatsoever. So I'm open-minded on the idea that tariffs do not have to have an inflationary impact. But first, we have to see what the tariffs are going to look like. And there's an awful lot of saber rattling going on with the tariffs. If you do something that the president doesn't like, it's instantly tariff talk. And I don't know, I don't think that's really healthy as a one-tool reaction to all policy programs. If you have a hammer, every problem looks like a nail. And if you're a tariff guy and you're going to respond to policies of foreign countries that you don't like and you're just constantly going to tariffs, I don't know. I think the effect of that will incrementally wear off. But we'll wait and see what the tariffs look like, and they need not be inflationary.
You have argued against the renewal of the tax cuts. I've asked you about that on several occasions. You've been pretty unwavering on that. Is that still your view today?
Yes, I want the budget deficit to shrink, and you're not going to do that by more tax cuts. So I don't really like the SALT thing in the tax cuts. I think it's really kind of absurd that was put on way back in the first Trump administration. That one I'd like to see go away, but otherwise the tax cuts, I don't want to see tax cuts. I want to see spending cuts. And I don't know if we're going to get that. Certainly history has not given you confidence that talk of reducing spending was going to result in a reality of cutting spending. But we shall see. Trump was a deficit spender in his first term, and I don't see any indications that that's going to change. And that's why I caution against high-risk positions right now, because I think long-term interest rates can go up, and valuations, as I said at the outset, are very high on credit in the bond market and on, obviously, parts of the equity market. So I'm favoring, again, equal-weighted equity exposure rather than market-weighted. That seems to have started to work. And I think fading the trends of growth versus value and small cap versus large cap, equal weighted versus market weighted. I think those got very extended during 2024, and I would not want to be betting on just a momentum trade that continues. So I like equal weighted in the S&P. I continue to like cash because Fed's not going to cut rates. Bonds on the shorter end to intermediate range, the price off of Fed on hold will continue to deliver. You can get 6% fairly easily. It's not going to make you rich, but it's a real rate of return of more than 3%. And I think you can live to fight another day when you get cheaper valuations in both stocks and credit bonds.
On that note, has what I like to refer to as the Gundlach model portfolio changed in any way? You like cash. You said last time 30% cash, 50% short-term bonds, 20% in U.S. stocks. That still sound right given what we know today?
That's about right. I might change something, in 05 here or there, but broadly speaking, that's the right parameter. About half money in relatively, middle credit to upper credit bonds in the shorter, to the 5-year area, 3-year area of the yield curve. I don't like stocks at these valuations, and I would still maintain maybe some of that cash you might want to hold in a real asset, perhaps a commodity fund, which seems to be showing signs of life. And gold, I think, has another move high as well, although it is near the all-time highs. But I still think dollar cost averaging into gold makes sense in this uncertain geopolitical environment.